Hey guys, welcome back to another video. My name is Josh and this will be the last video that I'll be making before Christmas. So if you're watching this before Christmas, Merry Christmas to you and your family. If you're watching this after Christmas, Merry Christmas to you and your family. Today we're going to talk about Plexure, stock ticker PX1. It's both listed on the ASX as well as the NZX. There's been quite a few people asking me what I think about the stock given that it has dropped from its all-time highs. So today we'll be taking a look at that, and as always, this is not financial advice, purely for entertainment purposes only. You should always do your own research and you can read the full disclaimer down in the video description below. But without further ado, let's get right into the video. So here we have Plexure's price history. As you can see, I'm not using Google, and that's because Google doesn't have the price history for PX1 going back a year. But as you can see here, over the past year, Plexure is up roughly 50%, and from its all-time highs of about $1.55, the stock is down roughly 21%. In case you're unfamiliar with the company, Plexure is a global mobile engagement company helping brands create sticky and more profitable relationships with consumers throughout the consumer journey. Harnessing the power of consumer, contextual, behavioral, and sales data, Plexure enables the delivery of deeply personalized, compelling offers to customers through mobile channels. So essentially, Plexure is a mobile marketing company. They create apps for companies and they send out personalized offers to people using those apps. If you're living in New Zealand, as most of my viewers are, Plexure runs the Macca's app or McDonald's app, and if you go in there, they have offers for you. So you use it, you redeem it in store, and there you go, you get more bang for your buck. And essentially this is what Plexure does, but for all their other customers as well. This mobile marketing industry is expected to increase quite significantly over the next few years. The global mobile marketing market size was valued at $65 billion in 2019 and is expected to grow at a compound annual growth rate of 22.9% from 2020 to 2027. So that is a huge runway for future growth going into the next 7 years or so. And that makes sense because more traditional retailers want to move into the digital space, and the best way to have the best ROI on your marketing is to use digital marketing. And Plexure is a company that offers that service essentially, and this is probably the way going forward. Mobile marketing is going to take market share from more traditional means of advertising. In that sense, Plexure has a significant tailwind in that the industry that they're operating is going to grow significantly going forward. So here are some of Plexure's clients by the numbers. The biggest one here is McDonald's with circa 11,500 locations across 59 countries. So Plexure first signed McDonald's in 2013, and they started out with one country and then they built it up over the years to currently in 2020, it's roughly 59 countries around the world. This is not a big contract to begin with, but over time it has grown, okay? So what's interesting to note as well is that McDonald's, which is headquartered in the US, also owns a 10% stake in Plexure. Other contracts that they also have now, Super Indo acquired in February 2020. Super Indo is a grocery chain in Indonesia, so that's 182 locations. They also acquired White Castle in July 2019. When I say acquired White Castle, I mean acquired the contract for White Castle. And currently they operate in 363 locations within the US. And lastly, they also have Loyalty New Zealand. So Loyalty New Zealand is the company that owns Flybuys. Also another big contract with 530,000 registered customers. Now, if we talk about the growth levers of Plexure, what they can do is they can expand across more countries that McDonald's operates in. Now, important to note is that there are some countries that they are not competing for. So these countries such as US, Canada, UK, Germany, France, and Australia, which is covered by a corporate-owned solution. And McDonald's China and Russia as well is covered by an internally developed proposition. So Plexure has mentioned that they have no current plans to compete with these offerings, but there's plenty of other countries with huge growth as well that they can tap into. Now, I also want to talk about Super Indo for a moment because this is a really interesting one. And on their website, you can see that they published the key outcomes of the partnership between Plexure and Super Indo. Some of the key outcomes is that within 3 months, Super Indo had reached 101% of its member registration goals for the year. Average basket spend has increased by 55%, okay? Now, this is amazing. This is a huge increase in basket spend, okay? That is literally amazing. And I think, this is really good ROI on their investment in the Plexure app. Another interesting thing to note as well, so Ahold Delhaize, I don't know how to say that name, is one of the world's largest grocery retailers and a global leader in e-commerce. It operates more than 6,500 stores across the US, Europe, as well as Indonesia. So if Plexure impresses Super Indo with the results and the parent company of that takes note of it, then chances are they'll also get Plexure to make an app for all the other stores around the world that they have as well. So there's a lot of room to grow with this partnership. Now let's take a look quickly at their revenue model. So we can see revenue for FY18 was roughly 11.4 million, increasing to 16.8 million in FY19, and then increasing to 25.3 million in FY20. 2/3 of their revenue is from recurring revenue sources, such as license fee, usage fee, support fee, and managed service fee. About 1/3 of their revenues are non-recurring. There have been a consistent pipeline of non-recurring revenue for several years, and management has alluded that this will continue into the foreseeable future. Now, with that in mind, let's talk about the recent updates from the company. First of all, they have announced half-year results showing revenue growth of 23% to $14.4 million, as well as cost growth of 79% to $18.8 million. So market didn't like this because revenue growth of 23% is significantly lower from their revenue growth last year of roughly 45%, and cost growth has increased way more than revenue has. And they also announced a capital raise, $37 million raised at $1.20 per share, and they issued 30.7 million shares in total. So first, let's take a look at the stagnant revenues for FY21. So the financial year 21 revenue is forecasted to be $29.1 million, which represents a 15% growth year on year. In the half year 21 report, they also say that no new customers are included in FY21's forecast, but the company is pursuing multiple opportunities. They also mentioned that Rona has delayed the progression of deal flow for a period of 6 months, with new customers now expected in FY22. And if what they're saying is correct, that there has been a delay in FY21, then FY22 should be a very good year because all the customers that weren't secured in FY21 is now being delayed into FY22. Now let's talk about the increase in costs for a moment. So total costs for FY21 is forecasted to be roughly 39 million, and I calculated that by taking the revenue that they forecasted minus the net loss that they expect, and that's roughly a 56% growth year on year in costs. Total headcount increased from 139 to 190. And we also have increased IT costs relating to a increased usage of $9 million. So this IT cost is up $2.5 million or 38%. Now, if you haven't noticed, revenue has only increased by 15% year on year, but at the same time, the IT costs related to usage is up 38%. So there is a revenue to cost mismatch here. Cost is increasing more than what revenue is increasing. And this is quite normal in more tech companies where the company is operating near operational capacity. The company will have to invest a lot more to increase their operational capacity. But then, after they've done that, the additional marginal cost is essentially zero. So now they're spending a lot more to invest into building up their operational capacity. And at the moment, there is a cost to revenue mismatch, which is also why we've seen such an increase in costs that is much higher than what the increase in revenue is. Now, management has actually alluded to this in the FY20 annual report. The company's revenue from contracts with customers of 25.25 million, so that's revenue last year, does directly correlate to our user numbers. This is because over 87% of the company's revenue from contracts with customers is linked to contracts that were signed in 2014, with pricing mainly based on store numbers. Now, note that they said signed in 2014, and remember earlier I said McDonald's was acquired in 2013. So a lot of the McDonald's contracts that they built up over time was signed after 2014. And they also say that, pricing is based on store numbers. So it's not so much how much users are on the platform, but rather how many stores they sign. So as more users go on the platform to use the app, that will increase cost over time, and that would mean that there's a mismatch between revenue and cost, okay? Now, also note that in 2019, the pricing model was changed, with new customer contracts being based on digital adoption, which will mean that as consumer usage grows, so too will the company's revenue from contracts with customers. Now we can expect that future contracts to more align the cost with the revenue going forward, which is good for the company because it won't lead to the situation where costs increase much more than what revenue has increased, like in the half-year results. Now, another headwind that the company is facing as well is forex movements. So the majority of Plexure's revenue is either denominated in Japanese yen or US dollars, while cost basis is based on New Zealand dollars. In the past half year, there was a foreign exchange loss of $500,000. And since the half-year results, the NZ dollar has actually strengthened even more. So I expect to see a foreign exchange loss for the full year as well. Now that we've talked about all the headwinds, let's take a look at the cash balance. So the cash balance as at 30th of September 2020 was 8.7 million New Zealand dollars. Cash burn based on the first half of 21 is roughly $5 million. And more recently, the company raised 34 million New Zealand dollars. The company should be quite comfortable for the next 3 years, unless, they somehow spend a lot more than they are currently spending at the moment. So cash balance, not really an issue here. Now, the last part of this video is valuation, and it's usually the most exciting part as well. Let's take a look at the valuation of Plexure versus other software companies in Australia. So here we are. Here's my Excel spreadsheet of market comparables. Now I'm using market comparables as the valuation method rather than an intrinsic value analysis, because Plexure is still a very growing company, early growing company. There is a lot of inconsistency in performance. So that makes forecasting very tricky. So easier method is to take a look at market comparables. Now I got a list of comparable companies from the analyst report that was actually on the Plexure website. And what I did was I updated the numbers because I didn't know when the report was issued. So I got the most recent numbers as of recording at least, of these comparable companies. What I did was then I took the EV to sales ratios for all these companies, and I also took the forward growth of the company. So FY22 growth, okay? So I'm taking FY21 EV to sales and comparing it to the future growth 1 year from then onwards, okay? And I also included which companies are profitable or NP, not profitable. I put this into a graph and I put a linear regression into it, just a linear model to show, which ones are trading at above average or trading below average. And here we are, Plexure PX1 is trading at good ratios because as you can see, the higher the EV to sales, the higher the expected growth. Now, Plexure is trading at roughly 5.4 EV to sales ratio, but they're trading at growth that is above average, okay? So this is based on FY22 growth, not FY21 growth. Bear in mind, because 21 growth isn't going to be much. It's around 15%, as management has alluded to. So based on this scatter plot, we can see that Plexure is trading relatively cheap for what analysts are expecting in the future from the company. What's important to note is that this analyst forecast is only based on one analyst because Plexure is still a relatively new company. So there's not a lot of analyst coverage on that company. And what that means is that there could be a huge standard deviation from actual performance of the company, right? Because it is better to have 5 analysts covering a particular stock and getting the average of those 5 analysts rather than just getting one analyst which is like bullish on the stock and using that as an expectation. So that's what I mean by standard deviation from actual results. So take of this what you will. At the moment, it does seem like Plexure is trading rather cheap for the EV to sales ratio, which is probably the method you want to use when the company isn't profitable. And yeah, if I exclude all the profitable companies, we can see that Plexure is still the same, trading at above average growth for what you're paying in EV to sales. So there you have it. That is my take on Plexure. I think the company has been plagued by short-term issues. Management did say it's because of Rona causing delays in customer contracts, and it's up to management to execute well in the future to show whether, you know, this company that was actually facing short-term issues rather than long-term issues. I think the company has a lot of growth levers in the future. They can expand into more McDonald's locations as well as Super Indo locations, because Super Indo is owned by a parent company that owns 6,500 retail stores across United States, Europe, as well as Indonesia. They are operating in an industry that is going to grow significantly in the future, so that is also good for the company. Plexure is roughly 3.5% of my total portfolio, and for me, this is a little bit of a speculative stock because we don't know yet whether the company will execute well going forward. Personally, I think they're more likely to be able to execute than not. But at this stage, I'm happy with my 3.5% allocation towards Plexure, so I won't be adding any more Plexure stock into my portfolio. Let me know what you're gonna do about Plexure stock, and if you enjoyed today's video and found it helpful, be sure to hit like and subscribe and share it with someone who you think will find value from it. Alright, but I think I've said enough for today. Merry Christmas, guys, and until next time, take care.